Hey, what's going on, everyone? Welcome back to another video. Today's video is going to be on supply and demand. I've had a bunch of requests asking me to go over this topic, and it's really simple. I've watched a couple of videos on YouTube going over this, and no one really seems to explain this in a simple and easy, understandable way, so I'm going to do my best to explain this. So let's get straight into this video. Supply and Demand by TraqFX. What is supply and demand? Now, before I go over the Forex definition of supply and demand, let me go over the the definition of supply and demand. So, initially, imagine basically everything in real life, everything in life is supply and demand, right? So, the term supply is used as the amount of product you have. So, for example, if you have a business, right? So some people have business of selling shoes, selling phones, and selling, food and drink, stuff like that. If you're in any type of business where you're selling something, where you're selling a product or produce or something like that, that's your supply. Your supply is what you're selling. So when you sell something and let's say you're in a restaurant and you're selling food, your food is your supply. That's what you're supplying. The demand is how much people are demanding that product. So for example, if you work at a restaurant and you're selling food, right? The thing that you're selling is going to be your supply, but the demand are the customers coming. So if you have more customers coming, that means you have more demand. But if you have not enough customers coming and the customers coming are extremely low and you're not making a lot of revenue, then you would say that you have lower demand because people aren't demanding the product you need. Now in Forex, the definition is kind of similar but a little bit different. Supply and demand in Forex is the understanding of how much hidden sellers and buyers there are at certain levels in the market. We cannot see the exact amount of sellers or buyers there are on the market, but supply and demand allows us to analyze where there's strong supply and demand. So initially, supply means sell and demand means buy. So demand equals buy, supply equals sell. The idea of supply and demand in Forex is just understanding at the current time how much or what's happening. Is there more supply, meaning is there more sellers trying to sell the market, or is there more demand, meaning there's more demanders of people buying the market? Supply. Let's go over supply zone first. Supply in Forex is very, very simple. Simply means sellers. You can only be on one side of the market. Either you're a buyer or you're a seller. If there are more sellers in a trending market, we would use the term supply is greater than demand. Finding supply zones are very simple. We will go over that in the next few slides. The next slide has an image explaining what seller's market with a ton of supply looks like. So focus on this term right here. Supply is greater than demand. All that means is sellers are greater than buyers, because that's all it means. Now this is an image that I just took on GBP, JPY, the Japanese yen. And over here you can see that this market is clearly trending in a downwards direction. Now you can make your little argument that it's not technically trending down, but I don't care. Basically, you can see that this move down was extremely impulsive. This move down was extremely impulsive, and so was this move down, right? And these are examples of strong supply in the market. Now, people still may be confused, like, oh, where is the supply? Don't worry, we're going to get into that. I'm just showing you what it looks like. Now let's go over demand. The term demand simply refers to buyers. If there is more demand in the market, that simply means there is more demand for the currency to be bought rather than sold at the current time. So like I said before, Forex is random, right? The market you can't ever really say that there's more demand in the market than supply, because it changes, it varies from time frame to time frame. But at the current time, if you're analyzing the structure and you're analyzing what the momentum is looking like, if you were supposed to say that there's more demand than supply, all that means is there's more buyers than sellers in the market. And then this is an example of strong demand in the market, where the market is clearly making newer highs and making impulsive decisions to go towards the upside and stuff like that. Now, how are supply and demand zones found? Supply and demand zones are usually found after a major impulse. Let me elaborate on this. We can't know where there's going to be strong demand before the fact. As retail traders, we need to wait for the smart money to leave its footprint in the market. After we calculate and find the footprint, we can make the case that there is supply and demand at these levels. Usually after a major impulsive move, either up or down, the start of those impulsive moves have a ton of demand/supply left over that the market needs to capture before making its next move. Now let me explain all of this if anyone's confusing. Supply and demand zones are usually found after a major impulsive move. Right here, we can see that this is our impulsive move. These are our major impulsive moves. We can't know where there's going to be strong demand before the fact. Now, what I mean by that is no matter who you're trading with, you could be trading with WWA, ICT. At the end of the day, if none of us really have friends that work at a hedge fund or something like that, we don't really have any idea where there's going to be strong demand and supply before we can see the impulsive moves. So the idea is, or the understanding is, you have to wait, because none of us really have an edge. All we really have is an understanding of how the market is moving, but we don't actually know how the market is really moving behind the scenes, because the market makers who move the market, they're in control, not us. All we can do is understand the footprint and follow up by that. As retail, I just went over that. After we calculate and find the footprints, we can make the case that there is supply and demand at these levels, like I just said. Let's go over the next example. So this is a demand example. We can see that this is our major impulsive move up. The gray zone is the major impulsive. Right here, we have another major impulsive move up. And the third one is we have another gray impulsive move up. Now, like I said in the previous slide, usually after a major impulsive move, either up or down, the start of those impulsive moves have a ton of demand/supply left over. Right here, we can see that this area is where the bottom was, way before the move started. This is where the start of this major impulsive move started. So was this. This is a red zone right here, is where the start of this major impulsive move, and so was this right over here. So what's interesting to me is after every single impulsive move we see, we're noticing that the market retraces back down and trades within these strong demand zones. It trades within this area where there's a ton of consolidation before a major move up. Right over here, we can see that after this major impulsive move up, we can see that price action retraces back inside to the start of this major impulsive move. And we can see that there's a ton of candles right here, and the market consolidates and then pushes back up. So price is tapping back inside of this zone, and then it goes back up once again. So really, they're using these demand zones as a trampoline, as you know, you can say, as a real life example. You could say that the market shoots up. As a kid would jump off of a trampoline, you go up in the sky, but then gravity brings you back down. But once you're back down, you hit the trampoline again, and then you go flying high once again. Another example right here, you see this gray impulsive move towards the upside, and then you notice that there's this area of consolidation before it, and this is at the bottom of this impulsive. As soon as we move away from it, the market eventually trades back inside of this impulsive move, and then makes its next impulsive move. Now, this is a supply zone example. We can see that the market pushes up into this point right here. The blue zone is going to be the impulsive move down, and the gray zone is going to be the supply. We can see that the market ends up going down a ton with a bunch of momentum. It sells off with a bunch of momentum, and then it retraces and trades back inside of the supply zone, which is going to be the start of this major move down. Once again, we have another major impulsive move towards the downside that cleared the previous low. And what the market ended up doing is it traded within, once again, the supply zone, which was at the top, at the start of this major impulsive move down. So you guys can start to see how and where the supply zones are actually being made. Now, don't worry about wondering how are you gonna mark this up. I got you guys. Don't worry. I'm gonna show you guys how to find your supply zones and mark it up properly. More in-depth explanation. Did you notice something? Every time the market creates an impulsive move, the market follows up by creating a retracement that retests the start of the impulsive moves. The reason this is happening is because before the market blasted away, it could not capture every single order. Because of that, millions of orders were left behind, and that creates the retracement. The retracement is simply the market coming back down to fill all the unfilled orders before taking off a second time. So what I mean by that is, if we go back to the demand zone example and we look at this, this one where my cursor is at, we can see that after this impulsive move started, the market came back down, right? But you can notice that this little doji candle right here, it wicked inside of the demand zone, and then it moved up. It moved up right away. But then the market ends up going back down inside of it. Why did this happen? Well, that's because the idea of demand is that there's buyers. That's what it means. Demand just means buyers. In this zone, there's a ton of buyers, meaning that there's orders left. Because remember, there's two types of participants in the market. There's aggressive and there's passive. Aggressive traders are the people who are entering with market executions, meaning they're pressing their buy and sell orders to, execute them at the current market price. The passive players are the big players that enter with limits. So the market taps in right over here because probably there is some type of buyers, willing to enter at this point in the market. It fills them in and then it moves away. But there's more buyers that are looking to get in at a cheaper price point down over here. So that's why the market goes back down to pick up their orders, and then the market moves away. But notice how it already tapped in once, right? And that's the thing. That's the difference between an order block, and I'll get into that later on. And same thing goes right here. The market pushes away, but then it comes back down. This candle first taps in. It gives you some type of reaction, but not much. And then the second candle comes in, gives you another type of reaction, but not much. And then the third candle with this long wick, we pick up all the orders, and then the market goes away. Now, let me go over supply and demand versus order blocks. Supply and demand is more of a zone rather than a candle. The order block is specifically one candle us traders focus on price mitigating, while supply and demand is a big zone. The market can retest a certain zone of supply and demand multiple times, while an order block is preferably tested once before making it invalid. I use the word preferably. So before someone comes at me and says, an order block can be tested 7 times, don't worry, brother. I'm not against you. But let me explain that. So right here, we can see that this is a zone of supply. We can see the market taps inside of it once and gives you a reaction. Now, if this was an order block, we would have said, yeah, this is not valid anymore, right? But because this is not an order block, this is a zone of supply, the market comes back and taps inside of it and then sells off. This means that there's a bunch of sellers resting here, everywhere. And this is how we're finding where there's a bunch of sellers. But that doesn't mean that you're supposed to sell at every single level of supply or demand. And now I'm going to go over what exactly you have to do next to actually find your supply and demand zones. Now, let me go over a trade that we actually went over taking in the mentorship program. Link in the description if anyone is interested, my bad. Well, link in the description if anyone's interested. So let me first go over what's happening over here. So first things first, looking at GBP JPY, at this current point in the market, we can see that the market was indeed selling off. Now, remember, supply and demand only works if you use market structure with it. You can't just sell every single impulsive move. So we could see that the market was trending in a uptrend at one point from a macro perspective. We have this high right here, and then we have a retracement of this low, and then we have another high right here made, and then another retracement of this low, and then we have another high made. Now, from this point, the market ends up selling off a ton. And just looking at supply and demand, right? Just looking at supply and demand, we can see that we were more in a demanding market rather than supply, because before this major move happened, all we really saw was big moves towards the upside. But as soon as we came to this point in the market, where the market came at 155.800, the market ended up grabbing all these sell orders. And what I mean by we won't ever know where the market is going to have supply and demand until after the fact. This is what I mean. The market makers at this point, they knew the market was going to fall. But we don't really know that the market is going to fall until we see market structure fall. So this is where we would start saying, okay, there's more supply in the market than demand now, because we can see this major impulsive move down. Now, we can also see that structure was slowly being broken. Multiple macro lows were being broken right here. And that's your first identification that the market can definitely be seeing more supply than demand in the market now. Now, going to the 4-hour time frame, just to get a better look at. Actually, no, we'll stick to the daily. We'll keep this simple. Now, from the daily perspective, one thing that I'm noticing, or the one thing that I want to go in depth, is how you actually mark your supply zones. So initially, the supply zone works like this. Whenever the market is trending in a downtrend, what you're going to notice is at the lower highs, which is going to be right over here. These lower highs are the areas of supply. Now, have you ever marked up an order block and the market did something like this? Like, let's say you marked up your order block. This area is your order block, right? And let's say you were looking to buy right over here at this line. This is your sell limit, sorry. This is where you're looking to sell. But the market does something like this. You put your sell limit, stop loss at the low or the high, TP right there. But the market does something like this. It comes near it, but then ends up selling off. Why did it do that? Let me explain to you. Basically, the order block is not a, something that the market has to mitigate right away. And an order block is more something that's preferably mitigated right away, but the market maker chooses when that's going to happen. A supply zone, or a demand zone, in this case supply zone, is basically a big zone where there's a bunch of hidden sellers. And that's where people are looking to get involved in. So you don't really, so what the thing is with an order block is just a candle. But with the supply zone, it's a big zone that the market is tapping into and then leaving right away. So for example, this area where the market created a lower high before following up with a lower low, this area would be a strong area of supply. We wouldn't be looking to, refine this down to a candle. Rather, we'd mark the entire area of consolidation inside this lower high, and then we, try to refine it after price action comes inside of it. So let me show you a good example of that right now. So from the daily perspective, from the daily perspective, we could see that this area is where the market last consolidated before selling off a ton. So all I'm really looking for is an area where the market consolidated before the market made its impulsive move. So that's number one. Find out where your impulsive move is. And there it is. It's right over here. This is that major impulsive move down that broke structure towards my left right over here. Now, where's my supply zone? Well, your supply zone is just a consolidation. So map out the high of the consolidation, which is right over here, and then map out the low of the consolidation, which is right over here. And this entire area right here is basically your supply zone. And this is where the market is going to be attracted to, because this is where the market last made its impulsive move down, but it didn't have enough time to pick up all these orders that are rested over here. So there's hedge fund managers that are getting yelled at by their bosses screaming, why the fuck didn't you sell over here? What's happening? So then what they do is they bring price action back up to mitigate or to pick up orders before going down anymore. So let me show you what that looks like. Let me just change this to black, make this look a little bit nicer. And yeah, so now how do you actually trade with supply and demand though? Because if I was supposed to just set a limit here, this would be major. That's 73 pips. I can't have a stop loss that big. Well, this is where you can combine supply and demand with order blocks and institutional candles. So inside of this supply and demand zone, if we go down to the 4 hour, right, you can see that now there's more consolidation happening. We could see all this consolidation. You can see that the market started its consolidation from the low and this is the highest it's been before end up selling off. So that means that this entire zone, this is our zone to play with. From a daily perspective, all you really need to do at this point is just find an institutional candle inside the consolidation. Now, something that I like to do is I take my Fibonacci, I get my range fib, and I would just measure the zone from the high to the low. So measure the entire zone from the consolidation from the high to the low. And this is the way I see things. The 50%, remember, this is a sell side market. So vice versa for a buy side market. Anything above the 50% is premium. That means that it's better to find an order block that's above the 50%. Anything below the 50% it's still valid, but it's not as powerful / strong. So the idea is 50% equilibrium. The 50% is your equilibrium. But what I like to do is I like to look for institutional candles that are above the 50. Now what I notice is that there's a IC candle right over here. Boom, boom. This bullish before the bearish candle moved down, and the reason I'm using the wick to wick is simply because there's more wick than body. Now we refined our zone from 70 pips down to 52 pips, and remember, you're trading off of the daily bias, so of course this is going to be a higher a higher risk higher stop loss than usual. But remember, when you're trading off of the daily candle or the daily time frame, it's normal to have these types of risk to rewards, and that's still at 8-1, which is really proper. So at this point, all we'd really wait for is price to trade back into our supply and demand zone. Now, as you can see, the market comes in perfectly into our supply zone. Not only that, but it wicks into our order block that we combined with our supply zone, and then from there it sells off right away. And you can see what the market did from here. It just completely sold off. But let me go over a trade that we actually caught inside of the mentorship. So once this supply zone got tested, that doesn't make this invalid, but it just simply means that we have to look for the next supply zone. Well, how do you know when the next supply zone is found? It's same thing. Find the next major impulsive move. So right over here, if I measure this, right, I can say that this is the next major impulsive move down. And the area of consolidation before price action falling was right here. So this is my next supply zone. Let me make this black. So this is the major impulsive move down, right? And then this big black box over here, this big black box is my supply zone. But I can't just sell off of this because this is way too big. This is 112 pips. I can't do that. So this is where you can start refining your supply zone. So you can go down to the 12-hour time frame and refine this and look for institutional candles inside of your supply zone. Now, same exact thing. Take your range fib and mark up from the low to the high or the high to the low, same thing. And look for institutional candles that are premium. I found my institutional candle right over here. This 12H I see. And this is where you could, take the open, or you could even go down to the 1 hour, refine it a little bit nicer if you want. I think in the mentorship, if I'll actually open my Discord right now live for everyone, just because, I'll actually do this live because I'm tired of everyone saying, you don't send your setups to the group chat, whatever. Let's go over everything right now. If we go to trading setups, right? And we go to this one right here. This is the 1H. You could see the date and the time and all that. The date was, I sent it all at September 26, 2021. So this is either Monday when the market opened or a day before the market opened. I'm not too sure. But you could see that I was looking to sell at 152.545. So let's go over that right now. Let's go over 152.545. 152.545. This was this 1 hour institutional candle right over here. Now I can delete this, I'll delete this, and delete this, and delete this. Now, let's go back to the 4 hour time frame and let me go over our supply zone. So the supply zone was right over here. This big area was our supply zone because this is where the market last consolidated before selling off. So this simply means that the market has a ton of orders resting all over this zone, some over here, some over here, some over here, and the market has to come back up to pick up those orders before selling its way back down. So what I did is I said, okay, I have my supply zone, which is right here, but I cannot have a big risk to reward like this. So let me go down to the 1 hour time frame and find an institutional candle that's pretty clean. I went down to the 1H and I refined my institutional candle down to this 1H level right here. Now, this institutional candle was found within a supply zone, and that is why we sold over here. And now the risk to reward was much better. It's only 31 pips, and this is, you could also wait for confirmation for a better RR, but yeah. So stop loss would have been just the high right over here. And then the market, you could set your TP all the way down over here. Now, let's simply just see what the market did from here. Look at that. Look at that beautiful entry, like to the pip. Come on. Look at that beautiful entry to the pip. And then the market ends up completely selling off. Now, someone, I just showed you that I did send this to the group chat right here. GBP, JPY, sell to buy setup. We're selling from here all the way back down to here. I sent it to the group chat. Yeah, so that's initially what's happening. And if you guys want a bigger time frame perspective of all of this, to make this even more simpler, just look at this. Just look at how easy it is to spot supply and demand. We have our first area of supply right over here, right? Boom, price comes in, mitigates it. The second area of supply, boom, price comes in, mitigates it. And each time we're mitigating those supply zones, the market is creating new lows every single time. Same thing goes for a demand zone. And let me go over a couple demand examples. Now, this is going to be all hindsight because we already know what's going to happen. But you could still learn from hindsight. There's nothing wrong with backtesting and understanding stuff like that. So right over here, we see a nice impulsive move towards the upside. Now, there's no way to actually properly know if this is your demand zone or if this is your demand zone, right? There's no way to really know yet until we wait. And like I said, we have to wait to properly know. So now what I'm seeing is the market selling off. So what I could do at this point is say, okay, let me go down to the 4H and let me see where the last retracement was. Now, the last retracement was right here. Oh, my bad. The last retracement was right here. Price went up, created its impulsive move, right here. So I'll make this blue. And then the market ends up selling off to retrace, and then it goes back up right here. So where was my last impulsive move? My last impulsive move was right over here. This major big area where the market bought up. So all I really have to do is just find the high and low of the consolidation before the market went up. The high is right here, the low is right here. So I marked up my box of demand. This is my area of demand. Now remember, this doesn't mean that you have to buy here right away. That's not it. This is just your idea that this is where there's a bunch of buy side demand, activity happening. So what I like to do is I like to say, okay, before price action taps inside of this, all this area is just sellers. As soon as we come in, this is where I'll start looking for buy side opportunities. Now you could refine your demand, supply and demand zones by looking at institutional candles. So right here we have an IC candle right here, this last bearish candle before the move up, right? You could even go down to the 8 hour, look for another institutional candle. It literally all depends on how you want to do this. But this is our area of demand and this is our institutional candle. Let's just see what the market does. And you could see as soon as the market taps in, comes inside of the institutional candle right here, right? Look at this. It tapped inside of this IC right over here. Stop loss would have been just the low right here, and then take profit would have been the next high. And then the market completely shoots up from here. Now, where's your next level of demand? Well, it's the next impulsive move. This is our next impulsive move that made a new high. This is the important thing, is that it makes a new high. So let me find the high and low of the consolidation. The high and low of the consolidation, this is the low, and then this is the high, right? Because this is before the market took off. And then that's my area of demand. That's all I need to know. That's my area of demand. Now, do I want to refine it into an institutional candle? I could definitely do that. So now this is where you could set a limit right here, wait for price action to come inside, do its thing, taps you in, and stop loss would be the low, and then take profit could just be the next high. Or you could, target areas like here, take partials, do your thing. It doesn't matter. But this is your area of demand. Now, this is where price action is going to be reversing. So remember, whenever the market is doing something like this, where it's selling off, it's not just selling off because it's ready to sell off forever. No, because you guys have to remember, you're actually trading real currencies, and currencies, the rate of currencies goes up and down. It goes up and down all the time. So a currency can't just randomly fall, because that would destroy an economy. That would literally destroy an economy, right? So these little drops are normal. It's normal to have these drops in currencies, but it's all about supply and demand. This is an area where there's a bunch of hidden buyers, where there's a bunch of demand, and this is an area where there's a bunch of hidden suppliers, a bunch of sellers, right? So all that really matters is prices retesting this area to pick up all those demands, to pick up all those buyers that are looking to bring price up because there's a bunch of demand, and then it looks for the next level of supply. So right here, we could see that, boom, the market didn't react off of this level. But why? Why didn't it react off of this level of supply? Simply because it didn't create a new low right here. That is why. As soon as we retested this area of demand, the market took off. Where's the next area of demand? Well, let's look again. Let's look for the high and low of the consolidation. I would say that this right here would be your new demand zone right here. Now, this is way too big. Don't get me wrong. This is way too big to actually trade. But this isn't, the supply and demand isn't telling you to buy right here. All it's telling you is this is the zone where sell side activity is going to switch. That's all it's telling you. And then from there, that's where you want to avoid selling and look for your institutional candle to start buying from. Now, I'm too lazy to do all of that, but okay, yeah, I guess. So the market did come inside here, as you can see. It tapped inside one time, and it gave you a nice 335 pip move. Tapped inside the second time, gave you another 274 pip move. The third time we broke the demand zone, we ended up breaking it, and then the market ended up taking off. Now, that's going to happen, but that's basically how the market works. So that is supply and demand in a nutshell, and that's how it works. You could also use it on the 5-minute time frame. Don't get me wrong. Even though inside, when there's if the market isn't a buy side market, that doesn't mean that there still isn't hidden sellers on the smaller time frame. You could definitely use supply and demand on the smaller time frames just as well. But you won't be getting those major moves like I showed you on the higher time frames. So for example, right here, this is also a trade I did send out to the group chat, but we got stopped out. Yeah, so this is an area where there was a bunch of supply, high and low of the consolidation, price tapped in. We found our institutional candle. The market reacted off of it, right? We get triggered in, stop loss at the high right here, and then we target down here. But guess what? Because this was a 1H supply, the market was only willing to give us 65 pips before reversing towards the upside and retesting a higher time frame supply, right? Which was this daily area of supply right over here. So that's also something you have to keep in mind. Supply and demand can be found on every single time frame. It's just about how you use it. Another example, on the 15, I took this sell before the market closed. Right over here, we have this area where the market was. We have the low of the consolidation and then the high, and the market sold off, terminating this low right here, right? And all I really need to do was find my institutional candle inside this level, which was right here, this last bullish institutional candle before the bearish move down. Price tapped inside of it, right? And then stop loss would have been just the high, and take profit would have been the next low. Now I'm actually in this sell. Well, not in it anymore. I did take the sell, but we closed it. And if you guys want proof of anything of that, sure, I'll post the link in the, or not the link, but I'll show you a Gazo link in the description. So just check that out. But you could see that the market is reacting off this level. Not necessarily a crazy reaction, but it gave you 26 pips, and 26 pips is all you really need for one day. Think about that. ICT said this once, and I respect him for it. ICT said that all you need is 10 pips a day, and that's it. And that's honestly true. Sometimes we get too carried out with chasing 300 or 400 pips a day. You might get confused thinking, wow, only 100 pips a day? That's not good. Sometimes you'll start chasing trades just for the pip amount, and you'll forget the actual percentage gain. Another example of a 1 minute demand now is right here. Like I said, the market terminated this high, and then what did it do? Price came back down to the impulsive move right here and retested this area of demand before taking off. Now, how would you refine this? Well, find your last institutional down candle before the move up and simply set your limit right there. And this is where the price action ended up reacting off of. Stop loss would be just a low, and take profit would be just the high right here. Another example right here, we have another major impulsive low right here. Some people might have not taken this because it didn't make a new low. I wouldn't have taken this, but remember, this is the smaller time frames, but price still ended up coming back down, came back to retest this area of supply, right? Look for your institutional candle, which is right over here, and you could have sold from this point with the stop loss at the high and take profit the next demand, which was going to be here. And then from here, you could buy it back up, right? And that's basically how the market is moving in a nutshell. So I hope this video made sense to everyone. If you guys have any questions, please leave them in the comments below. I try my best to reply to every single one. And for the people that are saying, oh my God, I can't believe I even have to say this. I'm so sorry, but please use your brains. Like, people that use my name in the comments, TraqFX admin, TraqFX lady, TraqFX, mathematics tutor professor, it's not me. I'm only TraqFX. That's it. And if you still don't believe it, click on the channel. If that person doesn't have the same amount of subs as me, doesn't have the same videos posted as me, and they're saying I'll triple your money from 100 into a trillion, and I'll make you the Prince of Saudi Arabia, trust me, it's not me. It's not me. I don't do investment plans. I don't do any of those things. I'm a normal human being, right? I'm not rich. I'm not like that. So don't think that if someone messages you saying, yo, his track said that he can triple your money, dude, I can't. So please be smart, use your intuition. And yeah, so take care, guys. I hope everyone had a good weekend. More videos coming this week. Peace out. Take care and have a good one.